Welcome to this short presentation on tax compliance in the digital age. Over the last 10 to 15 years, as technology and e-commerce has developed and boomed across the world, tax authorities have struggled with both the legislation and the methods used in administering taxes and collecting taxes from e-commerce and traders who are using multiple countries to trade from. In most of cases, the companies who are trading do not have physical trading premises like tax authorities are used to. And therefore, for many of them, they don't always have enough investigative powers or enough manpower to actually carry out proper compliance checks on lots of companies. As a result, many frauds have been committed. One of the most common ones is missing trader fraud, or sometimes known as carousel fraud, where companies continue to sell from one legal entity to another in a different European country. And this creates basically a chain where at the end, somebody does not pay the VAT, or one of the traders does not pay the VAT or goes bankrupt. Tax authorities have lost millions and billions of taxes from frauds like this. As a result, they themselves are creating much smarter systems to be able to find and prosecute traders who are evading tax. A recent study by the European Commission identified that 160 billion in tax revenues has been lost in 2014 alone. And this is predominantly from only intra-European traders. That is a staggering amount of money by any means. Just to put it into perspective, it's about a quarter of the UK's annual public spending budget, which is around 650 to 690 billion a year. Tax administrations themselves have embarked on very ambitious modernization and digitization programs, mainly to help them with reduction in manpower, but also reducing fraud and also to increase collection of taxes. The UK's HMRC has launched the Making Tax Digital program. Although many viewers will be aware that this program at the moment covers VAT, HMRC's longer term plan is extending it to self-assessment and other taxes like corporation tax, where they will be collecting data on a more regular basis and using analytics within software to actually identify anomalies and identify gaps in reporting between traders reporting corporation tax, VAT, and self-assessment. In Spain, they already have real-time invoice reporting. So companies that are above a certain threshold have to report lists of invoices on a daily basis to the local tax authorities, and then provide a monthly or quarterly VAT return depending on the size of the company. Spain has been one of the pioneers of digital invoice reporting, and their program has been live for about a year and a half now, but there are still some teething troubles. Greece was due to go live with real-time invoice reporting earlier this year. However, due to the COVID-19 pandemic, they have delayed the introduction of real-time invoicing by a few months. The current program was supposed to go live again in June, but I think that has been pushed back again to January 2021. Hungary has also gone live with near real-time invoice reporting. They have chosen to go with a weekly reporting regime, and basically they will capture every sales and vendor invoice that is issued to a particular company or trader, so that they can actually cross-check that against corresponding data they receive from their customers or vendors. All of these are resulting in companies having to work in different ways, and even accounting firms have basically increased loads placed on them. So software companies have also developed tools to help businesses to adapt to these changes, as well as help them to check transactions faster so that they do not get penalized by the tax authorities for incorrect submissions or by receiving penalties for misdeclarations of tax. There is also other developments in the world of digital tax. The OECD has created a standard called SAFTI, which is also being implemented by some European countries. Poland is going to implement SAFTI, as well as other European countries. The idea behind SAFTI is to create a standardized reporting structure similar to the common reporting standard, which is used to notify tax authorities of people having bank accounts or income or companies in their jurisdictions. The idea is that they could all feed into a central database and help to reduce tax fraud by being able to share information. So apart from getting people to submit data on a more regular basis, tax authorities themselves are turning to technology, data analytics, and machine learning. Using machine learning, they also are learning to identify anomalies in tax returns. They're looking for also duplicated information, or customers, for example, claiming the same invoice twice. They also have the ability to troll bank account details and use that to cross-reference to the data submitted by taxpayers. Data mining is one of the techniques HMRC uses in investigations, where they gain access to taxpayers' bank accounts and cross-check those against submissions of VAT or corporation tax. As a result, also by getting technology and data analytics, tax authorities are able to gain valuable intelligence, which helps them to identify fraud and identify suspicious trading patterns, as well as identifying traders who are using cross-border jurisdictions and reporting gaps to not declare their income correctly in one or more countries. Large companies have been the target of tax authorities recently. They have been one of the early adopters of tax automation technology, primarily because tax authorities see them as easy targets for revenue collection. Companies have basically invested in huge amounts of technology, ERP systems that will enable them to process larger volumes of transactions, but also some of the software they have invested in has been tax compliance automation and machine learning to be able to spot errors and potential cases of fraud much earlier on in the sales process, and to also be able to minimize and mitigate their exposure to penalties and fines from local tax authorities. Machine learning in tax compliance is still in its infancy, and very few companies have actually taken advantage of machine learning technology at this point in time. Many tax professionals still prefer to double check transactions manually to make sure that the machine learning part is working correctly. There are also other reasons why companies are moving towards automating the tax compliance process. Legislation such as Sarbanes-Oxley requires companies to implement stricter internal controls to eliminate internal fraud and error. But also companies see compliance with such legislation as a badge of honor, which makes them appeal to investors, and also makes them appear to be more ethical in the way they do business. By eliminating and reducing fraud and having stricter internal controls, companies sell themselves as being good companies, good with governance, and as a result of this, hope to attract investors. So one of the key areas of tax compliance or digitizing tax compliance has been the automated VAT calculation software that is available on the market. There are multiple products that actually calculate VAT, and this often is one of the biggest areas where tax automation software can add value. Companies doing e-commerce have to deal with very complex cross-border rules for VAT especially, and general sales tax. In the US, for example, general sales tax rules are based on the location of where the customer is based rather than where the supplier is based. So imagine every customer that is buying something from a website has to have a special tax rate determined for that supply, and companies often struggle with automating the rules for that. So several companies have come up with selling these as services. They maintain all the infrastructure, tax rates, and the calculation engines, and basically customers connect to them using APIs, application program interfaces, and that's used to calculate and send back the VAT or GST information. Larger companies, as part of their internal controls, are using daily automated testing of transactions. So there are companies that previously would have waited until the month end or the quarter end to actually look at all their VAT and tax transactions. Today, with the tax automation software, many companies are choosing to do it in real time or at the end of each business day. There are several products on the market, from SAP ERP products and other specialist suppliers such as Thomson Reuters Digita and CCH Walter. Companies and tax authorities are also using data analytics, often looking for patterns in purchasing and sales to identify anomalies. Many larger companies also struggle with legacy systems that may be used for billing or procurement, and often those systems, because they're legacy, are not always maintained with the latest information for tax. Therefore, some errors creep into the accounting of the companies, not by design, but actually as genuine errors because the master data or the tax rates are not maintained in those legacy systems. Tax compliance software can also help detect internal frauds. Many companies have had frauds perpetrated against them by internal gangs creating fake customers, fake suppliers. And again, by having automation in tax compliance software, it's easy to spot patterns of trade with certain customers or certain vendors that basically would point to internal fraud. And companies can use that as a trigger to carry out further investigations. So looking at all the different technologies on the market, the key to all of this is how does it all work and how does it all slot together. For the purpose of this video, we will only be looking at the tax compliance check software. And this is generally the process that is used in most tax compliance software. So there is a data and rules repository which is created by the tax software, and this is applied across multiple companies in the group. Just for awareness, these types of systems are used in big multinational companies, and smaller companies will not often have the volume of data to justify such an investment. So if you consider that a company operating in 20 or 30 different countries would want a certain level of assurance that all their VAT and GST transactions are tested to a certain level and to a certain standard, Therefore, they would want to have some standardization and tests that are vetted, audited, so that they can rest assured that the tests have been carried out correctly. Once these rules are created, they are customized for certain countries, because some countries will have different tax regimes, they will have different rules on reclaim of VAT or GST. And so sometimes these automations have to be customized for specific markets based on the availability of the tests, and also the ability to test certain scenarios which may not be relevant in other countries. Once all these tests are set up in the software and all the companies are set up correctly, the software runs based on a schedule, whether user triggered or on an automation schedule, and then it basically just trolls through transactions, and based on rules it will identify and detect anomalies. And once it's detected the anomalies, what it will then do is it will trigger various mitigating actions, and those mitigating actions will be a variety of possible things that can be done by the tax team to identify and correct those anomalies that have been identified. Subsequent to actually this cycle, what then happens is you have monitoring and optimization of the tools. So the tests are updated on a regular basis to make sure that the legislation that they're testing for is still up to date. They will also use historic data and actions from the previous steps to identify what the correcting steps should be. And as time goes on, the software will learn and be able to suggest how to deal with various scenarios that it encounters. So the data and rules repository will effectively set up the tests. You will be able to also document the tests and the logic. So this is useful for auditors when they come and look at the compliance processes of a company at year end. They will also be able to document the tests and the logic behind them. Local market customizations for special cases and legislation are also part of that armory. And as all data for a tax compliance tool is usually held in a central data warehouse, it also prevents people from tampering with the data and being able to corrupt it. So again, that is one of the audit requirements of companies, that the data integrity is maintained, especially when it concerns financial transactions. In tax compliance software, you basically create the scenarios and the testing, and this essentially is just creating a task list of all the different tests that need to be done on transactions. So simple tests could be just checking VAT rate against the VAT tax code. It could be checking the ship from, ship to address and just checking that the correct VAT rate has been applied. Or it can be checking for missing tax information like VAT numbers or tax identification numbers like a corporation tax reference, as well as being able to control the scenarios. Centrally, companies also have processes in place where changes to these tests and scenarios need to go through an approval process, and this ensures the integrity of those tests. Again, this comes back to Sarbanes-Oxley and similar corporate governance legislation that needs to ensure there is segregation of duties, and the same person cannot, for example, edit a test without other people having oversight and governance. The detection process basically looks for anomalies based on the tests that have been agreed and implemented, and then there is some analytics that happens in the background, which identifies some of the common errors and mistakes that are detected. Review and analysis of results, so looking at past history, seeing if the same results are coming up again with the same customers or the same vendors. Sometimes looking at certain specific document types and identifying duplicates of documents that may be appearing in the system, or multiple errors on the same type of transactions or the same transaction. Again, the rules can be varied, and each company will set up its own rules for detection. So what are the mitigating actions? The workflows are one of the mitigating actions. So systems for tax compliance will often trigger workflows to get transactions to be corrected. One of the biggest problems is errors or missing master data. So master data is information held on a customer or a supplier, and often you will find information like addresses, ship to addresses, ship from addresses, VAT numbers, tax identification numbers are missing. Workflows can also be used to trigger a manual investigation. Sometimes problems are too complex to just be handled by checking tax codes, and often what will happen is a manual investigation will be triggered, which will ask the people in the tax investigation department to look for source documents, validate them, and then attach them to the investigation file that exists often in the software. So there is full traceability and full auditability of all the actions that are taken by different users. And this again is a feature that auditors like, and also tax authorities like, because then they can actually drill down into the transaction and see exactly what has been done to mitigate the response to the error. Companies will win brownie points for taking due care in some countries, and that effectively reduces the penalties that tax authorities will levy against them if they can demonstrate that they have used reasonable care in checking the transactions, investigating them, and taking mitigating actions. There's also reminders that can be sent to users or task owners by the software. So it's one thing to send somebody a workflow and to ask them to correct a transaction, but the software compliance tools will also continue to follow up until the transactions are corrected or master data is updated. And they will also set deadlines, and if deadlines are not met, escalation workflows are generated to line managers and people much higher up in seniority in the organization. Companies generally do not like things not being done, and so they will use these features to basically enforce internal processes. The smart part of tax compliance software is in machine learning, and based on how users correct transactions or respond to a workflow request, the machine learning part of the applications will actually learn as time goes on and basically build up a database of what people have done based on certain rules. The automation basically needs to look at the specific organization's transactions. It cannot be preloaded with certain rules because each company's trading patterns are often different. Some of the actions that the machine learning can trigger are automation in corrections. So where we identified, for example, missing master data, this can be one of the candidates that will reduce the workload on the tax investigation department substantially, because the system can be triggered to request a correction to master data or a request to accounts payable or accounts receivable to stop trading with a customer who is missing information and therefore creating alerts within the system. So where does the intelligence for all of this come from? It sounds pretty simple. So how tax compliance is done at the moment is often people run reports and do lots of manual analysis using Excel spreadsheets. With tax compliance software and automation, as well as machine learning, basically the tax software has certain rules where it detects the anomalies. Based on the thresholds that are set in the software, it may be able to deal with some of those automatically. And so a vast proportion of the anomalies that are identified are closed by the software after a period of learning by machine learning. There will be a mid-range of transactions that will be identified that will require still a manual decision. And this would reduce the workload on a tax investigation team substantially, often by as much as 40, 50, 60% of transactions can be dealt with automatically, and then only about 30 to 40% will need manual intervention. You will also be able to set thresholds for value, and again, the software can deal with low value transactions automatically and only select transactions that are over a certain value threshold for manual intervention and investigation. At the moment, the intelligence is very much rules-based, and the learnings will be very much based on how users respond to certain anomalies. There is yet no real artificial intelligence in the software or in tax compliance. It is very much rules-based. Patterns are really what it's looking for, and essentially these are ways of learning the actions and the responses to certain types of transactions. So as the machine learns what to do with certain transactions, it will basically be able to do one of three things. It recommends an action based on past history. It will automatically take an action to correct based on past history and actions taken by previous users, or it can do nothing because it's learned actually that those types of transactions are false positives, and therefore are either because they're from a legacy system or they're basically just do not need to be corrected. Why do companies invest in machine learning, and what are the benefits? So one of the key benefits of this is it reduces workload on the tax team. If you work in a shared services center and are handling accounts for multiple companies across many different countries, essentially the workload is very high, and you do not want the team to be wasting their time with having to chase transactions that are insignificant, or where the reasons they have been selected for a check are basically regularly occurring errors, or that they are basically false positives. So companies are investing in this technology to reduce manpower. They're also using it to objectively assess a transaction and not rely on a person being too tired, for example, from the monthly accounting cycle to actually trap errors. A lot of companies have proven that automation is a lot more objective in the way it selects transactions, and also it reduces the workload on the teams, and therefore their time could be spent in identifying the higher value transactions and doing more value added work. By using artificial intelligence and machine learning, learning from how to deal with past transactions is also not lost. So the tools will learn from a team of anywhere from 10 people to 50 people. And obviously, as people leave the organization, that learning is not lost by them leaving, because all of that is captured by the tax compliance tool in its machine learning. The ability also to prove auditability and traceability of transactions, as well as the mitigating actions. will also reduce risk and compliance penalties. As stated earlier in this video, tax authorities will be more lenient towards companies that can prove to them that they took reasonable care in submitting their tax returns, and also showing that they corrected them before submission. So there are big benefits financially for companies to use tax compliance software. This brings to a close our presentation. Thank you very much for listening, and I hope you've enjoyed this presentation.